Now, Grant, how much longer do we got to keep reading things that make me go, and all the reasons why gold will go higher, but yet we're not at $5,000 gold?
Well, that's a good, familiar question, I have to say. Look, I write about it less and less now because...
Are you surprised it's taken this long?
I am surprised it's taken this long, but again, and I talk about this all the time, the price for me is, honestly, it's inconsequential. I don't own gold at $1,500 because I want to sell it at $5,000. It's just not the way I look at it. For me, it's an allocation that when the time comes, we'll do what it's in my portfolio to do. I'll be bigger, I'll be smaller at various points depending on what I think the short-term direction is. But as I said in my presentation yesterday, when I did speak about the price, it's the second time I've talked about the price since the end of 2015, because I think the setup now is very constructive for people that want
So this conference next year, whether it's at Vegas or whatever, gold, same, lower, or higher?
Oh, I think it'll be higher.
How much higher, in your opinion?
You're doing this on purpose, aren't you? Because I hate talking about what and when. But look, if it's not through $2,500, I'd be surprised. I really would be.
There you go. Things that make you go, Now, Cal, you won the same award that Rick won, the Murray Pesum Financier Award back in the day, and then you switched sides and actually went to run a company, and you're onto a world-class discovery. If anyone has not gone to the Liberty booth and you want to watch in real time what a massive deposit is looking like, you don't need to buy the stock, but it's an education to see what's happening. I brought you up on stage last year, and the stock was like 31 cents. You hit 98 on Friday. You're hovering in the 90s now. This is the first time I've actually, in a long time said, usually I'm pretty quick to take a Katusa free ride, and I said this one I'm holding on because of my mistake on Newmarket, which became Kirkland Lake. I sold a little bit too early. Why am I going to be right for not selling today on a triple?
President and CEO of a public company, you can't tell anyone in this room to buy or sell their stock. It's a security.
But tell me as a friend.
I'm not going to tell you as your friend, right? And you can't put a price target on something. But the best way to describe what Liberty Gold found, we've drilled 30% of 1 square kilometer of a 12 square kilometer oxide gold system. We thought the first square kilometer would take 90 drill holes to drill it off to an inferred category. We're already on the 90th hole. The stock has doubled because basically we're getting 20 to 100 meter thicknesses of 2, 4, 6 times the average grade of a current operating run-of-mine heap leach operation in the United States. And we're going to stick on the mineralization. We're not going to wander off trend because geologists will take an unlimited amount of money and fictitiously spend it on their imaginations. When you're in grade, you stay in grade. And we've got 3 drills on site on that project right now. A 4th goes in November, and now we're planning for a multi-drill program for that for all of next year. And we're just going to build ounces and build high-grade oxide ounces. That's it. That's the reason. So
I introduced you to Ron Peratt, who's an old friend of mine, and he's been involved in 2 world-class discoveries, Twin Creeks and Long Canyon. And he sold both. He was part of the teams that sold both to Newmont for $2 billion and change. And I said, Ron, I think I'm onto something big here. I'm a massive shareholder. Can you go do a follow-up site visit? Now, can you share with everyone what Ron's thoughts are on this?
Yeah, Ron went to site, and he came back from site, and as a matter of historical reference, the Long Canyon mine is the predecessor company to Liberty Gold. Liberty Gold is actually the stock dividend from the takeover of Frontier for $2.3 billion in 2011. The same geological team found that 2-gram rare ultra high-grade deposit. Newmont bought it. It's now in the hands of the Barrick joint venture. And Ron went to site and he said that 40% of the Black Pine system had the same footprint as the Twin Creeks deposit. And I think Twin Creeks has produced, 15 million ounces so far?
Produced 15 million ounces. And it has 10 million reserve.
And it has 10 million in reserve. And so we're just touching the edge of this. And
just so you know, he drilled Twin Creeks.
Yeah, he drilled Twin Creeks, and he was a co-founder with our geological team on Long Canyon. And Long Canyon, it was the most profitable mine of Newmont. It had an all-in sustaining cost of $359 US an ounce.
Has anyone on your team sold any stock?
No one.
So what I'm asking is, at what price does Cal Everett say, all right, I'm going to go drink wine and eat pizza?
There's no such thing as a price. If you can drill ahead of it and move your market cap in advance of your share price higher, you're effectively protecting yourself from somebody who's looking over your shoulder and covets your assets.
Okay. Can you share any interest from majors or nothing? You can't go there.
I can't tell you what they say to me, but I can tell you that there's not a single producer in the United States in the Great Basin that is not paying attention to Liberty Gold.
Now I bring the wet blanket on the stage, Brent Johnson. So everyone's talking about how gold's going to do great, and Brent, why are these guys wrong? I love putting you on the spot.
I don't necessarily think that they're wrong. I'm just not yet convinced. Well, I should say, too, it depends on where you're sitting in the world. And I think if you're sitting in the U.S., it looks much different than if you're sitting in Canada or Australia or Europe or Africa or South America, mainly because I think the dollar is going to get a lot stronger. And I think that will, at least in dollar terms, put somewhat of a lid on gold. So
explain that. So you saw my article, Why Americans Should Not Buy Gold.
Yep.
I did it because, facetiously it attracts attention, but walk people through this quickly.
Yeah. So I'm not telling people not to buy gold. I'm just saying if you do buy gold, don't expect it to pay off tomorrow. I think everybody should own it. I own it. I'm just not expecting as a US dollar investor for it to skyrocket tomorrow. Mainly because I think that, and I should clarify this a little bit, I'm much different than many people in this room. I'm not a geologist that, they start deep in the earth and work their way bottoms up. I'm flying over to 30,000 level.
So you're a macro guy.
I'm a macro guy looking down and trying to figure out where do I want to allocate capital. And I think that everybody should own gold as insurance, but I personally don't think it's a good time to own gold as a speculation.
So is gold going lower for this time next year? Like, do you take the counter bet of Grant Williams?
I think that in U.S. dollar terms, I think it's likely to be lower a year from now, or at least will have gone lower before going higher than currently.
So what is your opinion on buying gold stocks and gold royalties and all that?
As a U.S. dollar investor, I would just own bullion right now. I think there'll be a better opportunity to buy the miners.
So you sold all your Liberty Gold?
I did. Yes.
I'm just teasing.
I wish I had some to begin with.
So that's because you're flying too high. You're not paying attention to these geos.
Yeah.
So Patrick, now you come from a totally different perspective. You're in the options world, and it's a good way to cap or hedge your portfolio, specifically if you're a junior resource investor, because people don't actually ever relate the speculation of the juniors and playing the hedging to kind of lock in your prices. So where do you see the gold price going over the next 12 months, and what specifically are you doing to make money?
All right. Well, I'm very bullish on gold. I'll take the other side of Brent. And in the end, gold here has technically broken out of a very significant consolidation, and we've just finished a short-term technical bull run higher that is now consolidating. A lot of the technical levels would suggest it could go down to 1,400 on the very short term. I don't believe it's going that low, actually, but the sheer amount of people that I've heard tell me that they're buying the dip at 1,350 tells me it's not going to 1,350 if it's a bull market. If it goes to 1,350, it's probably going to go to 1,200. I think that at this moment, gold will probably consolidate up here. But like you were suggesting with options, what I really love about the gold options market is because of the contango in gold futures, and largely because of the fat.
So explain this dance, the contango.
Well, it just means that the forward price of gold is higher as you're going out on the term structure, and that means gold a year or two from now is at a much higher price than spot gold is trading. And the second thing that's in the nature of the options market in gold is that it's fat right tail skewed, which means that call options on an implied volatility basis become more and more expensive when you're going out of the money. This allows you to build all sorts of amazing option strategies around gold that allow you to build a trade where, for instance, you could go 5 points lower on the GLD, buy a protective put, go out 10, 15 points on the upside with a covered call, and actually do it very close to a near zero cost. And you have the upside, plus you have a downside hedge. If Brent is right and gold goes down, you can extract the intrinsic value of the hedge, bring your cost base lower, and have a better starting point. And so I'm long gold. I just have it hedged. I mean, at this point, I'm very bullish. I think that it's going to go higher, but I'm hedged if I'm early.
Okay, and I really like that collar strategy you have. Cal, this is a question I asked Rick, and you've made a lot of money. I've known you for a long time. Other than your own company, Liberty Gold, of the companies outside in this room, which ones do you think geologically are very interesting for speculators? Because this crowd here, they want to find the next Liberty Gold.
Oh, that's a good one. First, when I do my investments, I avoid geopolitical risk. So my portfolio is in Canada, in the United States, safer parts of Mexico. I look at Australia, but I don't see the value there, and it's tough for us to trade it in Canada because we're not looking at the Aussie Stock Exchange. The big discovery that I think could wake up the markets is in a very illiquid stock. It's called High Gold, and it's in Alaska, and it's kind of an Eskay Creek lookalike. It's got about a $35–40 million market cap, and they're re-drilling a deposit that was discovered by Westman in 1993. And the historical grades in that deposit, even though it was faulted off, and now they found the continuation, they had 100-meter intercepts of 10 grams gold in there. And there were 50-meter intercepts of 20 grams gold.
Now, do you think
when you see a market cap like that of $45 million, and whenever those numbers come out, and if they can find the extension, it makes sense to me.
But do you think with Tognetti, Rob McEwen, and Eric Sprott, they cornered the private placement on that at 40 cents, or was it 45 cents?
Yeah, it wasn't Eric, it was actually Neil Adshead.
Oh, Neil Adshead,
yeah.
Which is Sprott. So there you go.
Yeah. And
Smart
I thought
guy.
that was one of the best geological calls I've ever seen. So if you ever look at Neil Adshead's work, he's a brilliant scientist, and he's nicknamed Dr. No, because he's turned down so many deals. And when I went and looked at the geology, I went and bought stock in the market. I wasn't part of the financing. I bought 85 cents to $1. When the deposit's sitting in the middle, but the alteration zone is going 5 kilometers on either side of it, and it looks the same, the deposit's not going that way. The targets are going that way. And when you haven't drilled 4.5 kilometers on it, that's where your blue sky is. And you've got the right alteration for an Eskay Creek or a Hod Maden clone like
so
we
what
see
about,
in Turkey. It looks
they're
good.
not here. Give me a name of a company that you've seen walking around here that you're excited about.
Around here, I like Equinox. I think Equinox has got growth because I like Castle. Right? I just like big oxide gold systems. So Equinox I like a lot. There wasn't a lot here that I really cared about, really. Because it was geopolitical risk. I'm just going to look for North America. And
Okay.
sometimes these targets are too early stage for me.
So Grant, now I want to get into your brain trust there on negative interest rates, because this will play big time into the US dollar and where we're going with the global macro. Do you think negative interest rates are going to be sticking around, or is this just a flash in the pan, a Band-Aid solution for the bankers?
Well, if you look at history, it's a flash in the pan, right? But we all thought it was a crazy idea when it first happened, and then we got to $17 trillion of this stuff outstanding. So
Look how fast that 17 trillion.
No, absolutely
happened.
right. Look, it's had a couple of periods where it's reversed. It looks like it's going down again, but we're at the point now where it's the only solution is to drive these rates lower. And as someone pointed out yesterday in one of the discussions, people are buying these things for capital gains. I think it was Stephen Moore was talking about it with you, yeah.
Which is crazy for a bond market.
It's crazy. Look, it is crazy, but there's a whole lot
economics.
There's a whole lot of crazy stuff going on. And I think you made a great point yesterday about the fact that this could go on a lot longer than people think. But people should look at WeWork. And if you haven't looked at WeWork and you've just kind of seen the headlines, just look into this thing, because you had a company here that was ridiculous. I've been writing about this thing for 2 years. It was a ridiculous company. It didn't make sense. None of the numbers added up. The idea didn't add up. It was smoke and mirrors. But this thing still got to a point where they were going to try and float it at between $60 and $90 billion. And nothing happened. Nothing happened. They put the S1 out, which detailed the company as a precursor to an IPO. And for some reason, a few people in the press woke up that morning and decided, we're going to have some fun with this thing, because it was ridiculous, right? And that thing went from a $60 to $90 billion IPO to being bailed out at $5 billion in the space of 3 weeks. And nothing happened. The narrative changed. That was it. So with negative interest rates, we know they're going to keep doing them. At some point, people are going to wake up one morning and go, and I think Rick made a throwaway line yesterday about the Greek government finally telling the truth. That is brilliant insight. It's such a great observation, because that's how fragile all this thing is. That's how fragile a world of negative interest rates is. If people wake up one morning and say, oh, hell no, it's over.
Imagine defaulting on a negative interest rate too. I wonder who's going to be the first country to default on a negative.
Can you imagine? You have to
I say
get investors
Argentina
to pay you. Yeah, it's crazy. But that's the world we live in.
Now, Brent, what about you? Like on the negative interest rates, you and I have talked privately, so let's share the discussions we've had on that, because I think you and I differ a bit.
So, the negative interest rates somewhat plays into my theory of the dollar getting stronger. I know there's a lot of people in the gold world who believe that the dollar is headed to zero because that's what fiat currencies do, and I completely understand that argument, and that will eventually happen. The issue is that all the other currencies in the world are also fiat currencies, and they also have run-up debts, and they also have unfunded liabilities and unbalanced budgets. And so as our yields, even as they come down, they are positive versus these negative yields all over the world. And so I believe that drives capital to the U.S., which deprives the rest of the world of more dollars, which creates even more chaos abroad, which drives even more money to the U.S., which pushes the dollar up even higher. You get this vicious cycle. And going back to who's buying all these negative interest rates, what many people don't realize, and how many people in this room own any of the negative interest rates? I will bet $1,000 right now that somebody in here does, because the biggest owners of the negative interest rates are State Street, BlackRock, Vanguard, and the other big mutual fund companies in the United States who have created indexed bond funds. And if you have a 401k or you have an IRA in which you've bought a mutual fund, I almost guarantee you that you own a negative interest rate bond. I can't say that for sure, but I'd be willing to bet that somebody does. And it's because of the way, and again, the rise. I'm getting kind of different theories mixed together, but over the last several years, this move from buying individual securities to just buying indexes, and then also having the machines do the decision making for you rather than a human making a rational decision.
As long as the equity rises, passive investment will follow. Hence, my argument is it's going to last longer.
That's right, and it's it's the simplest algorithm in the world. If there's cash in the portfolio, you buy. Simple as that. It doesn't matter the price. It doesn't matter if it's a negative yielding bond. The Austria issued a 100-year bond a year ago at par, and this summer it was trading at 170. So in less than a year, it had gone up 70%. I literally had the borrow on it. I was ready to short it, and I decided not to do it. It went to 210.
That's madness.
And it's literally it's because of these algorithms, and it's because of the machines. They have to buy. Not only that, the indexes are market cap weighted.
How do we get these passive funds into our mining sector?
Yeah, there's a lot of it's the same dynamic. The same way that GDX can make the career of a junior miner, it can crush it too, right?
Correct.
The same thing will happen with the negative bonds at some point.
So I want to contribute to that and put a little bit of context, because I look at it in a much bigger picture, and we can tie it back to gold when looking at it. But I think it's all about the fact that we're in a period of financial repression. It's not about $17 trillion of a negative yielding debt, but it's about the fact that there's $250 trillion of credit stock in the system. And when there's this much debt, the countries have to deal with it in certain ways. Now, you suggested there an explicit default, where we could just default on this negative debt, but most countries and systems will use things like inflation or austerity or try to grow their way out of a problem. But what we're witnessing is a period of financial repression where they're maintaining lower nominal interest rates in order to create negative real yields. And that's a wealth transfer from creditors to the debtors.
And don't confuse that negative interest rates are a war on wealth. It actually is a genius plan by the central bankers, because the majority of democracy will vote for that.
And so the financial repression is the way that they're managing it. It reduces the government's interest burden on servicing the debt. It reduces the deficits. It's a way that they're managing this $250 trillion of debt in the system. And to me, if you kind of look at a scenario, well, what would happen if they let interest rates rise? Something has to give. And therefore, I think the financial repression will continue. And because of that, gold is an important safe haven from which you kind of separate yourself from this system and all of the way it's bogged down.
So the next thing I'm going to do, he doesn't even know I'm going to do this. Grant, do you remember when I took you up to the copper mine, and then that night I'm like, oh yeah, by the way, we're going to have dinner with Rick and Bonnie and my wife, and I pick them up at 5 o'clock in the morning. I think I dropped you off at 1 o'clock in the morning. And these guys are so much smarter than me. I ended up picking up the bill. And Rick, I want to share, what I love about doing this is sharing the discussions we have privately to you and to the YouTube world. Rick, what would be one question you would ask Grant Williams that, you would want your clients to know?
Oh, there he is. Let me think about it and ask me again in 3 minutes.
Okay, Grant, what would you ask Brent about his vegan milkshake theory, or
Look, Brent's milkshake theory is great, right? I think the only thing I always like to hear from Brent is how can you be wrong? Because the problem with any theory like that you think out really well and makes sense, like Kyle's rational investor paradox, right? Brilliantly thought out. You've got everything kind of neatly tied up. How could you be wrong about the milkshake theory?
There's lots of ways I could be wrong, but I think
which potential flaw in it
the biggest potential way would be if Donald Trump came out and unilaterally devalued the dollar. Now, there's many reasons why I don't think that is likely at all, but it is possible.
What happens if the Democrats win?
What's that?
If the Democrats win, like someone like Elizabeth Warren, or could that throw off the momentum of the U.S. dollar?
That might actually spike the dollar even higher.
Why?
Because I think that they are just as likely to do MMT as anybody, and MMT is.
Explain MMT.
Okay, so in very simple terms, MMT it's kind of a battle between government and the central bank of who's going to control monetary policy. Right now, central banks control monetary policy by buying bonds from the public and putting currency into the system. MMT says the governments, we're just going to print it. We're literally going to spend the money into existence. And it gets into the hands of the public quicker because it doesn't go through the banks first. And so while that may actually push the U.S. stock market forward on a stimulus concerns, which would draw even more money to the United States, which would suck even more capital out from the rest of the world when new money's not being printed, so to speak, it's just being spent in.
But hold on, if she bans all oil, the reverse of the petrodollar, which is a huge benefit to your theory, that ends, right? Because
if she bans oil?
Well, she said she's going to ban all production of U.S. oil, right? All fracking. And that's been 50%.
It could, because then we wouldn't be exporting and importing the dollars.
That's right.
That could hurt it.
That'd be a big boon. Rick, are you ready or no?
Sure, I think. So, Grant, what would you say to the postulation that negative interest rates are a function of a perception that because of demographics and because of the lowering cost to society of goods and services as a consequence of technology, that negative interest rates are a function of a perception of deflation rather than a manifestation of manipulation by the central banks?
No, I think there's a huge component of this that isn't necessarily
if you repeat
manipulation.
The question for everyone.
But I think everyone out there probably heard it better than I did because it had to get through them to get to me. Did everybody hear the question?
I didn't understand the question. I'm just
if you look at it, central banks, with the exception probably of Japan, haven't actually taken rates negative. This is a function of people moving into these bonds. They're doing it out of fear. They're doing it out of greed for capital gain. And when you get greed and fear represented in any asset, I mean, it's like the perfect setup. And I think that's what we're seeing. I think there was a great piece that Charles Garve wrote recently about a visit he made to Holland, and he sat and talked to one of the Dutch pension funds, and he said, you guys are hoovering up all this negative yielding debt. Why don't you put your capital elsewhere? And the guy told him that the regulators basically said, you have to do this. He said, I know this is a stupid thing to do, but I have to do it. So right now, there are so many tailwinds for these negative interest rate instruments, but they're not actually direct mandates from the central banks. I think that may well come if things start going the other way. There'll be all kinds of mandates on what pension funds have to hold, which kind of instruments. But I think your point is very well taken. This is not manipulation. This is market forces. That's not to say that it's a smart thing to do, But I understand the reasons that they're all doing it, but I don't think it is manipulation.
But remember, I want everyone to truly understand that negative interest rates are by definition completely deflationary. That's why I call it the FTD. That is the worst thing the bankers and the government would ever want, is a deflation. Now, do you guys agree or disagree with me, Brent?
No, I totally agree. The monetary system is not designed for deflation.
No.
It literally can't.
And that's why I call it a quantum economics. We're in a new realm. Now, before we go, I'm going to ask some questions to the audience. Just quickly, what percentage of your net worth is in gold, precious metals, physical, or equities, these companies that are
I'm up
exposed
to
to it?
just 35%, give or take.
And what percentage cash in US dollars?
US dollars, I've got some US dollars now. I've got a lot of Singapore dollars still.
Okay, what percentage cash altogether?
25.
25? Cal?
I really haven't even thought about it.
Depends how high Liberty goes.
No, it's not that. It's I would say I'm probably in only 6 or 7 gold stock positions in my portfolio, and I would say that might be 20% of my net worth.
And what percentage cash?
Cash would be probably 20%. I think with lower interest rates, and I don't ever think the U.S. interest rates are going to go to negative or even zero, because it's a pillar marker for all currencies in the world. So it might drop the rates 2 or 3 more times. But I buy pipelines, telcos, and power utilities. I don't really care about the commodities themselves, but they pay dividend increases of 5 or 6 points year over year, and that would probably be 30% of my portfolio on top of the rest, and the next would be 30% in real estate, partially spread between the U.S. and Canada.
Okay, Brent?
So I've got about, I'd say 20% in gold, physical gold bullion. I don't own any miners right now. I probably have about 15% cash. I should say, I own
1.5 or 5.0? 15 or 50?
15 in
Okay,
cash, but
1.5.
I have over 50% in strategies, which I think will pay off if the dollar gets stronger. So,
And you're very bearish Canada.
I'm very bearish Canada.
I
Yes.
waited, I'm going to put some money into your fund, and if you guys want to know what he's doing, I just wanted to make sure that Canada voted for demise, and that happened last
they
week.
did. They did.
Patrick?
Well, first off, from a U.S. dollar perspective, as a Canadian, I have a lot of assets in Canada, but all my liquid assets are in U.S. dollars. And when it comes to gold, like everyone here is looking at it as a percentage of portfolio, I don't look at my positions the way that a conventional money manager would, looking at it as a percentage of a portfolio asset mix. I don't believe in diversification because I think it dilutes all chance of making good money. And so I like to concentrate into big positions. So I'm at least one time over the value of my portfolio exposed to gold. But from a risk perspective, about 5% of my portfolio is at risk of loss from my
Any questions
positions
from
in
the
gold.
audience? You got some really good guys here. Yes, sir, quickly.
So Donald Trump was trying to get Julie Shelton on the FOMC, which is probably like one of the best things I tried to afford, and was a whole lot I afford for.
What is your question?
But what I find confusing is Julie Shelton, she started talking about, she like exactly opposite of all her track record, like saying nothing about balance sheet reduction.
Okay, the
Yeah,
newest
I know what you're talking about.
The question is, this news member, they're not gold standard, it ain't happening.
Yeah, I'm sorry. It's just not happening. It's this idea that Donald Trump wants a gold standard is
Guys, get that out of your
absolutely
head.
crazy.
It's great copy for newsletters, but it's
listen,
complete bullshit.
The market may push gold to 10,000 or 20,000 or 50,000 or whatever the number is, and it may enforce governments to buy gold or use gold for a short period of time, but no government is going to willingly go back.
Grant, you agree or disagree?
I did a presentation last year called Cry Wolf, which actually talked about this. And the point I was trying to make was people think about the gold standard the wrong way. You all think about it as being a decision that gets made. Oh, you know what? Hey, we're going to go back to a gold standard. It's not a decision that gets made. It's a decision that gets imposed on the market after you see a 1929, 1930 type event. It's a way of resetting the system or bringing stability back. So I expect at some point there will be some kind of gold standard, but they're not going to sit around and discuss it and say, hey, why don't we go back to a gold standard? It's a solution to a problem, not something they're going to voluntarily.
Question there with the man with the hat.
Question on the big picture. Is the business cycle solid. We've gone 10.5 years without any real correction in the markets. How long can this continue? I mean, typically I've watched these business cycles over the years, and they come to an end at some point.
Australia's in its 29th year of expansion.
I know, but
Yeah, no, for sure. No, the point I'm making is these things can go on if you get a perfect storm for a lot longer than you would imagine. I think the business cycle is still valid. Hundreds, if not thousands of years of human history will tell you that. You can see how hard the policymakers are trying to stop the next part of the business cycle, which we all kind of understand, I think, is the downward half. But this is a natural cycle. It's a cycle dictated by humanity and how we see the world and how our emotions drive that. So I don't think you can stop it. You can throw goodies at people like low interest rates and encourage them to borrow more money, and that will keep it for a while. But ultimately, this thing is going to topple over under its own weight, I think.
Yeah, I think I will first of all concur. It's maybe the best answer or question I've had at a conference in a long time. I think it's maybe the most important question out there. And I think the fact that central banks and monetary authorities have tried to remove the business cycle so thoroughly that we're going to have a big readjustment when it happens. I happen to believe, because they've suppressed it for so long, that things are going to get even crazier than they already are before that happens.
I don't underestimate the ability of central bankers to introduce new imaginary variables like you would do in quantum economics. And we just entered this, and we're still in the early stages. And I'm going to end it off on that note. I think where we're going to go is going to shock a lot of people and surprise a lot of people. Thank you.